Welcome to the debate on breaking news to trading moves. I mean, imagine this for a second. You enter a perfectly planned swing trade on, let's say a Monday morning.
We've all been there.
Right. The setup is totally flawless, but by Wednesday, the stock is just, it's just drifting lower.
Slowly bleeding out.
Exactly. It hasn't hit your stop loss yet, but that red number on your screen is just glaring at you. You start sweating. You start second guessing the entire thesis. And finally, you just hit the sell button purely to relieve the stress. And then, like clockwork, on Thursday, the stock rallies 20% without you.
It is the absolute worst feeling in the world.
It really is. If you have ever been in that exact position, you know the absolute agony of a premature exit. So today, we're examining this persistent challenge in swing trading. Specifically, why do traders abandon their positions before the setup actually has time to develop?
It's a massive hurdle for so many people.
It is, and I'm taking this stance that this is primarily a psychological failure. It is a failure to manage the intense emotional discomfort and, really, the warped perception of time that takes over the exact moment your capital is at risk.
And, well, I have to push back on that right out of the gate. I do not believe this is inherently a psychological problem or, some lack of personal patience.
No.
No, I contend that this lack of patience is actually a symptom of a structural failure. Traders exit prematurely because they are trading without precise invalidation parameters. Emotional exhaustion only happens when you are operating in a structural void.
Okay, let me elaborate on what I mean by the psychological failure first, because, well, the time distortion element is very real.
I'm listening.
When you deploy capital, your perception of time completely alters. Swing trades are designed to play out over several days, maybe even weeks, right?
Right, that's the whole definition of a swing trade.
Exactly. You might identify a strong trend or a clean breakout level. But what actually happens the moment the order is filled?
They start watching every single tick.
Yes. Traders immediately fall into the trap of staring at a 5-minute chart for a trade that is literally supposed to last 3 weeks.
Which makes absolutely no mathematical sense.
It makes no sense. But we do it anyway. A single quiet session on a Tuesday suddenly feels like an absolute eternity. It feels like a complete failure of the thesis just because, well, nothing happened today.
But you have to ask, why are they staring at that 5-minute chart in the first place?
Because the human mind is hardwired to crave immediate feedback. We want immediate reward. The friction here is entirely psychological.
I don't know about entirely.
Well, a large part of it is. The urge to close a slightly red position arises purely to remove the emotional pain of uncertainty. We open up our scanners. We get distracted comparing our current slow-moving trade with some other stock that happens to be running really fast that day.
Chasing shiny objects.
Precisely. The core hurdle is that the mind focuses on the immediate profit and loss rather than trusting the original thesis. People think swing trading is more relaxed than day trading because it operates on a longer time frame.
It's definitely not.
Right. Emotionally, holding through days of uncertainty is actually much, much harder.
Okay, that paints a very vivid picture of the trader's emotional state. But, and this is a big but, you have to ask yourself why that uncertainty exists in the first place.
Because the market is inherently uncertain?
Well, yes, but you are describing a trader who is relying on hope rather than strategy. Traders do not lack inherent patience. They lack a defined plan.
So you're saying the emotion is just a byproduct of bad planning?
Exactly. Without a clear entry, a structural stop, a target, and a defined holding period, every single tiny price tick on that 5-minute chart demands a new decision.
And decision fatigue sets in.
Right. The material points out clearly that patience becomes nearly impossible when the trader has no structure to lean on.
I get that, but
if a trader enters a position without knowing their exact invalidation parameters, meaning they have not drawn a definitive line in the sand that says, if the stock drops below this exact price, my thesis is officially wrong and I am out, they invite that exact emotional chaos you just described.
But they often do have a line in the sand, and they still panic.
Do they really, though? If you don't define whether the setup is a breakout, a pullback, or a continuation before you click buy, you are just guessing.
Sure, defining the setup is crucial.
A swing trade absolutely needs room to breathe, but that room has to be defined by mathematical parameters on a chart, Not by how much emotional pain a trader can tolerate on a Wednesday afternoon.
Look, I see the logic in having lines in the sand, I really do. But let me offer a different perspective on this. Reacting to totally irrelevant market noise is exactly what destroys a perfectly valid trade, regardless of where your lines are drawn.
Noise is subjective, though.
Not really. Let's compare a swing trade to flying a commercial jet.
Okay, let's hear it.
Intraday volatility is just turbulence. If a pilot dives the plane toward the ground every single time they hit a bump, they're going to crash.
That would be a terrifying flight.
Right. In trading, normal consolidation or slight pullback is just turbulence. It must be endured. Traders enter expecting a smooth, immediate vertical climb, and they panic when the stock just, chops around for a few days.
Because they don't know what the chop means.
But the trade is still completely valid. The market just needs more time. The problem isn't the setup. The problem is the trader reacting to turbulence that was never relevant to the actual flight plan.
I like the aviation analogy. I really do. But how do you know it is just turbulence and not a dual engine failure?
Well,
That is the core issue here. Labeling valid price action as mere noise is a very dangerous trap. How do we differentiate between harmless market noise and genuine structural failure?
experience, reading the tape.
No, structure. There is a very sharp distinction between patience, which is respecting a valid, predefined plan, and stubbornness, which is ignoring objective evidence that a setup is completely broken.
Okay, fair.
If a stock drops below a key daily support level, that is not turbulence. That is the engine catching fire.
But let me challenge you on making that specific differentiation in real time. I will admit I have been guilty of this exact thing.
We all have.
You are in a trade, you're expecting a move, and a minor pullback begins. To a nervous trader, a minor pullback looks exactly like the beginning of a massive breakdown.
Sure.
So how does your structural approach actually stop the mind from playing those tricks? Because when you are staring at a screen, losing money in real time, a normal intraday dip genuinely creates the illusion of a total collapse.
The structural approach stops the mind from playing tricks because you define the boundaries of the playground before you ever put capital at risk.
Elaborate on that.
You avoid confusing consolidation with failure by establishing what would prove the idea wrong beforehand. You ask yourself, where is the stop based on market structure?
Okay.
Let's say you are buying a breakout above $50. Structural failure might be a daily close below $49.
Right.
If the price pulls back to $49.50, the structure objectively tells you it is just consolidation. It is just turbulence.
Mathematically, yes.
The emotion you describe, that absolute terror of the pullback, is simply the symptom of not knowing where your trade is structurally dead. Without a stop based on structure, every single red candle feels terrifying, because it could theoretically go to zero.
I completely agree that knowing where the trade is dead is crucial. But knowing it conceptually and tolerating it emotionally are two entirely different animals.
If you trust the math, it shouldn't be.
But we are human. A trader can write down their $50 breakout and $49 stop level on a notepad. They can tape it directly to their computer monitor.
And I've seen people do exactly that.
And they can still panic sell when the price hits $49.50. Why? Because the psychological pain of seeing that red position becomes intolerable. The structure exists perfectly on paper, but the human psychology just overrides it in practice.
See, if the psychology overrides it, I would argue the structure was actually incomplete.
How so? A stop is a stop.
A complete structure goes beyond just a price level. It includes defining the likely holding period. You must ask, how much time will I give this trade to develop?
The time parameter.
Exactly.
If you study your setup and define that it typically takes 2 weeks to resolve, you are far less likely to panic on day 3 when it is just chopping around.
That makes sense in theory. The emotional exhaustion you were talking about comes from making decisions on the fly. When you fully define all the parameters, both price and time, you remove the need for continuous stressful decision-making.
Okay, but that leads perfectly into the reality of how markets actually move, which ties directly back into this emotional battle.
Go on.
Markets have a notorious tendency to test support levels and build a base. They intentionally shake out impatient traders before expanding in the original direction.
The classic stop run.
Exactly. This is the classic weak hands phenomenon. Institutional algorithms hunt for liquidity, and they know exactly where retail traders are feeling the most pain.
They target that $49 level.
They do. And many of the strongest, most profitable moves begin right after a highly frustrating period that shakes out everyone who lacked emotional endurance.
Okay, but
Let me just finish this thought. Surviving this specific engineered consolidation phase is the hallmark of a successful swing trader. The market applies maximum psychological pressure, causing traders who want instant momentum to exit just moments before the real move starts.
I accept the reality of base building, and I completely understand the mechanics of algorithmic liquidity hunts and shakeouts.
It happens every day.
It does. However, I strongly caution against using the weak hands narrative as a universal blanket to justify poor trading.
Poor trading?
Yes, the text provides a clear warning about this. It does not mean every slow-dragging trade should be held indefinitely. Some setups genuinely just fail.
Well, obviously.
But traders very often use the weak hands narrative to justify holding dead setups. They tell themselves they are just bravely surviving a shakeout, being a strong hand, while their stock bleeds straight through major structural support.
They fall in love with the stock.
Right. The exit has to be based on the thesis breaking, not on some romanticized idea of having diamond hands.
That is a fair warning. Holding a broken trade is obviously destructive. But let me pose a direct question regarding your time parameters.
Sure.
If a trader must ask, how much time will I give the trade, before entering, doesn't setting a strict time limit force them out right before those weak hands leave the market?
Not necessarily.
Think about it, though. You could have a structurally valid trade. The price is holding above your $49 stop, but because your arbitrary 2-week clock ran out, you exit.
Okay.
Then, on day 15, the expansion happens. Doesn't your rigid time structure create the very premature exit we are actually trying to solve?
That is a critical point, but asking how much time will I give the trade is not about setting a self-destruct timer that automatically triggers a market order.
It sounds like it, though.
No, it is about aligning your initial expectations with market reality. If you expect a fast momentum continuation that should resolve in 3 days, and the stock is still consolidating in a messy, choppy range after 2 weeks.
You're saying the thesis was wrong.
Your initial thesis regarding momentum was factually wrong. Exiting because the momentum thesis is invalidated is not being a weak hand. It is recognizing that the empirical evidence is changed.
So patience isn't just blind holding.
Exactly. Patience means respecting the plan while the setup remains valid. If the defining characteristic of your setup was speed, and the speed vanishes, the setup is broken. You aren't exiting prematurely, you are exiting appropriately.
I hear that logic, I really do, but I maintain that the internal dialogue a trader has during that 2-week consolidation is predominantly emotional warfare. It is not a calm, rational review of empirical evidence.
It should be.
But it isn't. You look at the chart, it has done nothing. You look at a scanner and you start comparing your trade with faster stocks. Another ticker in the exact same sector is up 15% for the week while yours is flat.
FOMO is a powerful thing.
It is the urge to abandon your valid, safe setup to chase that faster stock is a battle of discipline. It is a psychological struggle. You are focusing on the immediate gratification you are missing out on instead of trusting the original thesis.
But the structure
of your trade did not change. Your emotional endurance simply eroded.
Look, I just cannot buy that it is purely an emotional erosion occurring in a vacuum. The emotional erosion is caused by the uncertainty of an incomplete plan.
Even with a complete plan, it's hard to watch.
If you have clearly defined your holding period and your structural stop, that 15% move in another stock is completely irrelevant data.
Irrelevant data that still hurts to look at.
Your structure shields you from the exhaustion because you do not have to make a decision today. You already made the decision before the trade even began.
That's the ideal scenario.
The best swing traders are selectively patient. They wait calmly while the trade remains valid, and they exit decisively when the evidence changes. They don't fight an internal emotional war every single afternoon.
Well, if we want to talk about where structure and psychology truly collide, we have to talk about the real elephant in the room here.
Position sizing.
Exactly. Position sizing. It is incredibly easy to say, stick to the math and respect the plan when we're just talking theory.
Of course.
But when that red number on the screen represents a mortgage payment or, a month's salary, the math completely goes out the window.
Because they sized too large.
The text clearly states that oversized positions make normal market volatility feel incredibly dangerous. A trader who risks too much capital will struggle to sit through even a modest pullback.
Because the absolute dollar risk is too high.
Exactly. When a position is too large, the brain literally stops seeing a chart. It starts perceiving financial loss as a literal physical threat.
The primal brain takes over.
Yes. A minor pullback triggers a genuine fight or flight response. Your amygdala is firing. Adrenaline is pumping. This directly causes emotional, impulsive exits.
I don't disagree with the biology of it.
By reducing position size, the trader buys the emotional capacity to follow the plan without reacting to the fear. Position sizing is the dial we turn to manage our psychological state. It turns down the volume on the pressure, ensuring we have the discipline to actually let the setup develop.
So we completely agree on the mechanics of sizing, but I frame it entirely differently.
How so?
It is a mathematical risk calculation, not an emotional coping mechanism.
That feels like semantics.
It's not, though. The fundamental rule is that the correct position size must allow the trader to mathematically accept the stop before ever entering the trade.
Right. Position sizing 101.
If the potential dollar loss feels unbearable, the position is simply too large for the account size. The math being wrong is what causes the emotional reaction. It is a structural error made at the moment of order entry.
But calling it a structural math error completely ignores the human element of trading. The numbers on a screen translate directly to physiological responses.
Only if they are the wrong numbers.
You can mathematically calculate risk perfectly based on account percentages, say 1% of your portfolio. But if that dollar amount exceeds your personal psychological threshold for pain, you will still exit prematurely.
Then 1% is too high for that specific trader.
Exactly my point. Position sizing is not just about account math. It is about finding the exact threshold where your brain remains calm enough to execute the plan. You are managing the human being, not just the spreadsheet.
I understand the subjective experience of loss, and I know the physiological response you're talking about is very real.
It's crippling for some.
However, I would argue that if a trader requires an artificially tiny position size just to avoid a fight or flight response, they do not actually trust their system's mathematical expectancy.
Or they just haven't trained their emotional tolerance yet.
When a trader genuinely understands their edge over a large sample size, they do not need emotional crutches. They need strict adherence to the parameters.
So it all comes back to the initial questions.
The questions asked before entering are paramount. Is the potential reward mathematically worth the risk? What specific price action would make me hold, reduce, or exit?
Right.
These questions separate planned, professional decisions from amateur emotional reactions. The discipline lies in following the pre-written instructions, not in finding a magic position size that magically prevents you from feeling fear.
It is an interplay between the two, certainly. But even with perfect math, a proven edge, and pre-written instructions, the sheer act of watching a position go against you requires a fortified mind.
It requires discipline, yes.
Having a stock hover right above your structural stop for days on end is agonizing. You can mathematically accept the stop before the trade all day long. But when reality tests that acceptance with real money on the line,
that's where the rubber meets the road.
The structural plan often goes out the window if the psychology is fragile. A trader can be completely correct about the market direction and still lose money, simply because they exited too early out of sheer discomfort.
Which brings us right back to why the structure must be completely rigid. If you rely on having a fortified mind or total emotional control, you will eventually fail.
Why?
Because every single human being has days where their psychology is fragile.
That's true.
You might have slept poorly, you might be stressed about something else, or you might just be having an off day. But if you rely on a hard rule that says, I only exit if the daily candle closes below $49, the rule does the heavy lifting for you.
Taking the human out of the equation.
Exactly. You don't have to be brave. You don't have to be emotionally fortified. You just have to be obedient to your own predefined plan.
Well, as we step back and look at the whole picture here, it is clear we both agree on the core outcome.
We definitely do. Exiting a swing trade simply because it is taking longer than expected or because of a minor intraday dip is a critical error. Successful swing trading unequivocally requires allowing the market adequate time to either confirm or invalidate the setup.
Absolutely. We are in total agreement that the ultimate goal is disciplined patience.
Right.
Patience means respecting the plan while the setup remains objectively valid, and, crucially, avoiding the stubbornness of ignoring evidence when a setup is clearly broken. It is about objective reality versus subjective feeling.
Yet, our underlying disagreement on exactly how to achieve that remains. I maintain that mastering the emotional urge to react to discomfort is the primary key.
The eternal debate. The structure is merely the map. The psychology is the vehicle that actually gets you to the destination. If you cannot manage the warped perception of time, the fear of loss, and the physiological discomfort of a red position, the map is completely useless. You will abandon the route at the first sign of turbulence.
And I maintain that discipline is a natural byproduct of strict pre-trade structure. Relying on emotional fortitude instead of clear mathematical invalidation parameters leads directly to stubbornness, exhaustion, and eventually blown accounts.
Both paths require work, that's for sure.
If you build the map correctly, with a precise entry, a structural stop, a clear target, and a defined holding period, the vehicle essentially drives itself. The structure protects you from your own destructive impulses.
It is a delicate balance between the mind and the method. Sometimes the absolute hardest part of executing a well-planned swing trade is doing absolutely nothing.
Just sitting on your hands.
Exactly. Just sitting on your hands and letting the market work. For everyone listening right now, take a hard look at your own past trades. When you look at your trading journal, were your early exits truly driven by a genuinely broken thesis?
Or were they driven by fear?
Right. Were they driven by the fear of a red position and the desire to just end the discomfort? Answering that honestly will determine whether your next trade is a planned success or just another emotional reaction.